Our presenters for today include Kyle Leopold, Patina Nation Financial Advisor, and RBC Wealth Planning Consultant, Corey O'Brien. With that, Kyle, I'll turn it over to you.
Thank you, Dave. Today we'll be discussing a topic that should be addressed for many important reasons. A lot of our topics focus on the financial aspect of planning. This topic is far broader in scope. It is geared to provide financial security, security for loved ones, and most importantly, security for your independence. If you had time to review the documents we sent out before this presentation, you would have seen the financial impact of no planning as well as the emotional impact. Today with us is Corey O'Brien, Wealth Planning Consultant for Capitus Financial Midwest. Corey joined Capitus in 2006. As a sales vice president, his goal is to help financial and insurance professionals provide innovative life insurance products and resources for using life insurance-based strategies. Corey has extensive product knowledge and works to assist financial advisors with identifying life insurance needs. Capitus Financial, which offers a full range of carriers and planning expertise related to life insurance, disability income, annuities, long-term care, and investment-related products. The reason we partner with Corey and Capitus is that they are not beholden to one insurance company or one insurance product. As a general practitioner, Corey has complete open architecture and unbiased recommendations. I'd like to turn it to Corey.
Thank you, Kyle, and thank you, Patina. I appreciate being here. As Kyle mentioned, I represent Capitus Financial Midwest. I don't represent any life insurance company. Really, what my role is to work with financial advisors and their clients and on the protection aspect of financial planning. Protecting against passing away too early, protecting against taxes, protection against disability, and what we're going to talk about today, protection against long-term care. And when I mention long-term care, I mention issues that arise that you're not going to pass away from, but your life or living life, you're really going to have some challenges. And we aim to do this planning not just to protect the individual, their assets, their family, but a lot of people don't know this, but right now in the U.S. there are 40 million caregivers. And these caregivers sacrifice an estimate of $3 trillion a year in lost wages, lost income, lost pension benefits. So we look at $3 trillion a year, that's $3 trillion a year that could be going into our economy. So we don't do this planning just for ourselves, for our assets, and for our family. This planning will benefit our economy as a whole.
Great, thanks, Corey. Let's dive into the presentation.
Now, if we look at living later in life, there are two things that are important to do so. Number one, we need our health. And number two, we need our wealth. And these things oftentimes are intertwined. And we'll talk about some of the costs later on if we become sick. And of course, we need our wealth because we need to be able to live later in life and afford the things that we want to do.
We all have family members that have been impacted by a sudden, unexpected health concern and seen its impact on financial and non-financial aspects of planning. Today, we're going to explore the intersection of health and wealth through the lens of healthcare and the impact that healthcare will have on our planning. The goal of this presentation is threefold. One, discussing the statistics in the long-term care industry. Two, the concerns that families and caregivers need to be aware of. And three, the potential options available in long-term care planning.
Now, today's agenda, we're going to talk about the risks. Kyle's going to go through an RBC survey that was performed. We're going to talk about planning for the unexpected, a reality check, some statistics that you might not be aware of. And lastly, we're going to talk about the options for long-term care planning. So starting off, we're going to talk about the risks in retirement. The first one is longevity, or the risks later in life. We're going to talk about longevity. And of course, people are living longer right now. There's a 63% chance that one person, age 65, if we look at a couple, there's a 63% chance that they'll live to at least 90. there's a 36% chance that they'll live to 95. And there's a 10% chance that they'll live to 100. Now, we're just talking about life expectancy here. Now, I think another thing that's important to think about is if we look at physical prime. We look at what our physical prime is today. Our physical prime today is essentially the same as our physical prime was 100 years ago. It's actually medicine and technology that's keeping us alive longer. Life expectancy, it's getting longer, but it's the red zone that's getting longer. So there's a bigger chance that we'll need help later in life with just essentially living life. Number two, we're going to talk about inflation. If we look at an inflation rate of 3%, it essentially cuts our purchasing power in half in a 25-year period. We look at market performance, sequence of returns or controlling sequence of returns. It's one of the biggest challenges a financial advisor has. Low negative returns, especially when you have a long life to live later on, can really cause problems to your portfolio. And you definitely want to be able to prevent selling low. And we look at healthcare. Healthcare costs, they're actually rising faster than inflation. Couple age 65, they may spend almost $500,000 to cover their medical expenses. And there's a 70% chance that one will need long-term care in the future. And that's just going to cause those numbers to increase.
Corey, at what age should this planning be addressed?
Now, I think kind of the sweet spot to start addressing it is between 60 and 70 years old. Reason being is at that point, generally clients are aware what their spending is going to be, what their assets are going to be. 70, I don't use that as a hard ceiling because there are, if you use insurance products to do this type of planning, they're available up to age 80. But really, you see an increase in cost, or the cost of waiting is quite a bit higher over age 70. And under age 60, generally it's clients that had an experience with a loved one where the most common response is that I get is, I don't need to do that quite yet.
As Corey mentioned, RBC generated a survey. We commissioned a survey to shed light on perceptions of healthcare. The study included over 1,000 individuals across diverse demographic categories and asked them to share their level of preparation expectations for the future. This included those who are employed and those who are already in retirement. Across all categories, one major theme emerged. The respondents are overwhelmingly concerned. 80% of those responded that they are concerned about funding the cost of care. 56% have factored healthcare expenses into their plan, but only 50% of those with the plan are likely underestimating those costs. It is increasingly important to begin planning for these costs, understanding your options and building a care plan before an event occurs. Carefully consider the impacts of your decision beyond finances, to include family dynamics, level of care, and quality of life.
Now, if we look into planning for the unexpected, now I try not to use statistics as much because I think emotion is more important in this type of planning. But if we look at 65-year-olds, there's a 70% chance that someone will need some form of long-term care. And now these statistics, these numbers, they're based on 2017. So they've actually gone up a little bit since then. But if we look at a need for a private room in a nursing home, it's $92,000 per year. Now, again, that's national average. And if you need to go into a nursing home for the average stay, 2.5 years, we're looking at almost a quarter million dollars that's going to be paying for your care. Now, that is for full care in a private room in a nursing home. There are, of course, different levels of care. All of them have varying costs. If we look at staying at home, obviously the figures are quite a bit lower, but the duration, the care is needed is quite a bit larger. So those numbers will grow if that type of care is needed. Now, as I mentioned, these are nationwide averages. And I have a resource that I'm going to share with you that I think is a pretty good resource. And I encourage you taking a look at it based on where you are, is Genworth has a cost of care map or a cost of care survey. And these numbers right here, again, they're national averages. They're 2019, so they're updated a little bit from the presentation. But if we look at a private room, right now it's about 102,000. It's growing at about 1.8% per year. If we look at the need for a home health aide, it's about $52,000 a year, and it's growing at 4.55%. But what I like about this resource here, and I know a lot of you are from different areas, is you're able to put in where you're located. And we're located in Milwaukee, so I'm going to go up. We're going to type in Milwaukee. And you'll see the estimated costs for Milwaukee are actually higher than the national averages. We look at the home health aide, it's $62,000 per year. You look at a full private room, we're looking at $130,000 per year. So I would encourage you to take a look at this website, type in your location, and it'll give you an estimation of what the costs are there. And also what's nice is you're able to project into the future. And if I'm 50, I'm 60 years old, I'm curious what these costs are going to be in, let's say, 20 years. You'll see that a private room in 20 years is $236,000. So that's something that you have to consider if you do this type of planning, is what is care going to cost when I'm likely to need it?
Ray, could you share with the audience how you got to that website?
How I got to the website?
Correct.
Now we'll share a link to the website later on. And if you Google Genworth cost of care, it's going to be the first link right there. But we're going to share a link with you after the presentation.
Now, Corey, we can clearly see the costs of this type of care. But what are some recommendations in terms of coverage levels?
I think the coverage level that I like to start at is $5,000 a month. I like to start there. Of course, when we look at the cost, it's not going to cover everything, but I find an expense for an insurance product to cover the entire cost is generally a check people aren't comfortable writing. So I like to start about $5,000, but I also like to look at, and everyone's different. Everyone's portfolio is different. Everyone's income's different. Everyone's family's different. I like to look at allocating maybe around 1% of the investable assets into an insurance product. Then ideally, we're just using a portion of the growth of the portfolio. And of course, if pension income is high, something like that, or if spending is low, I might allocate a little bit more. But with this type of planning, it's always kind of a happy medium between a benefit that people are comfortable with as well as an expense that people are comfortable with.
Thanks, Corey. So this slide, what we'd like to focus on here is the impact of family providing this care. Providing care would likely compel a child to put aside his or her life. Based on our survey that we talked about previously, 83% of cases that were surveyed, caregivers are family members of the individual requiring care. Typically, it's the middle-aged women, usually the oldest daughter, children who hold full-time jobs and have their own immediate family. 25% of caregivers spends 9 to 20 hours a week providing care, and 20% of caregivers spends 40 or more hours a week. The average caregiver can spend more than 40 hours providing care.
Now here, I can only talk about like my scenario here. If my parents needed care, my brother lives in Brooklyn, my sister lives in Las Vegas, and I have a 1 and a 9-year-old at home. I can't afford to take off of work to take care of my family. That's number one. Number two is I know I don't have the talent or the skills to take care of someone. I know in several years ago, Megan, she had full reconstructive knee surgery. And still every once in a while, she reminds me of how terrible of a job I did taking care of her. I know it's a talent that I don't have. And then if we look at the emotional impact of it, I don't know that I can handle it. It's hard trying to take care of a loved one. And you can look at surveys, half of caregivers are depressed, half of them can't sleep, half of them can't even maintain a consistent weight. It really doesn't just consume your time, but it's really a challenge for a lot of different reasons.
This slide was previously sent out over an email on the Patina Nation website. Really what to take away from this is that, as I mentioned previously, 75% of caregivers are female. The typical caregiver is a 49-year-old female caring for a 69-year-old female, most likely a relative and most likely her mother. 60% of Alzheimer's and dementia caregivers rate the emotional stress of caregiving as very high. The majority of caregivers have full-time jobs, yet need to go in last, leave early, or take time off to care for other family members. And really what this slide is explaining is really just rhetorical questions that we would like the audience to think about. What impact would the expense of long-term care event have on your retirement or savings? How do you feel about your family providing your personal long-term care, bathing and dressing? How much of your long-term care expenses are you willing and able to pay for? Where would you prefer to receive your care? And finally, does your family have expertise in providing your care? Corey, if you could expand a little bit on some real-life scenarios.
Yeah, in a lot of people, if they look around in their life, an aunt, an uncle, a grandparent has been impacted by long-term care challenges. Now, if I take a look at my grandmother, for example, my grandmother is mid to late 80s right now. She's always been a challenge personality-wise, and several years ago she had a stroke, and she's not able to take care of herself anymore, and she had no plan in place. And she would move to an apartment close to my mom and my stepfather. They would take care of her. They'd take her to the doctor. They'd take her to the grocery store. And after about a year and a half, she got tired of their rules, and she moved by my aunt. After about another year, she was tired of my aunt's rules, moved back by my parents. And she's gone back and forth about 2 or 3 times. And, you think to yourself, she's really something else. She's a challenge, and she is a challenge. But you look at it from her perspective is she's lost her independence. When someone else is taking care of you, the sad truth of it is you're living by their rules. That's really the end of it. And so that's why this planning isn't so important, is you want to maintain your independence as long as you can. And another example that I have is a good friend of mine, her grandparents. They're in their mid 80s now as well. And her grandfather was diagnosed with dementia several years ago. Several years ago, he was diagnosed with dementia. And after a few years, her grandmother wasn't able to take care of him and didn't want to take care of him anymore. And so she divorced him. And I don't even know where he's receiving care. I don't even know who's taking care of him right now. But her grandmother's in a big house by herself now. Her family members have to come over once a week to take care of the house, clean the house, empty kitty litter boxes, things like that, wash her hair. And so she's very much a burden on her family. She's very much a burden on her family. And that's what everyone says. I don't want to burden my family, but without a plan, that's essentially what happens. And she's also a danger to herself. One day, they found her. They came over on a Wednesday. They found her. She had fallen, and she wasn't able to get up. She wasn't able to get to her phone, and she sat there and laid there. And when they found her, she was severely dehydrated, and she could have easily died. She could have easily died if someone didn't find her when they did. And she had this entire time, she had a life alert that she could have hit. And she didn't do that because she didn't want to cause a scene in the neighborhood. And I think in the back of her head, she didn't want to make that admission that she can't take care of herself. Someone else needs to. And with that being said, that's why this type of planning is so important. And I'm not saying buy an insurance contract. I'm not saying that at all. I'm saying have a plan in place, whatever that plan may be. And this slide goes through some of the options of what you can do. Number one, and this is kind of the default plan, pay out of pocket. Well, you could save an extra $80,000 to $230,000 to cover the average stay if you need to go into a facility or you need someone to come into your home. You could use a home equity line of credit or reverse mortgage, something along those lines. And now when we talk about using our own money, generally that money is going to come from an investment account, or it's going to come from something like that where you're going to be taking the money out, you're going to be paying taxes on it, and then you're going to be paying a facility or a caregiver. So if we look at something like $90,000 a year, realistically, I'm taking $120,000 out, I'm paying taxes on it, now I'm writing a check. Now there are some write-offs there, but it's not a very tax efficient means of doing it. Now, the second option is the government. And I have a challenge with this one. Medicaid, it's important that it's there, but realistically, it's a welfare program. It's for people that don't have assets. And I sit in a networking group up in northern Michigan about once a quarter. And in January, they had an estate plan or an elder care attorney come in. And she was talking about all the ways wealthy clients are spending down their assets, getting rid of their assets so they can qualify for Medicaid. And really in the back of my head, it doesn't make sense, because if I'm wealthy and I have a means to do planning, why do I want low quality services? Or not low quality services, but it's not as good as it would be otherwise, and the choices aren't necessarily there. And one other thing I'm going to mention that's not on this slide is a lot of people think Medicare will cover long-term care expenses, and that's not completely true. Medicare is designed for conditions that you're getting better from. It's not designed to provide care to essentially do the best it can to just maintain you living a comfortable lifestyle. And the last thing that I'm going to mention is family. And we talked about a little bit about that and some of the challenges that you can have if a family member has to take care of you. So that really leaves in what I use every day is I use insurance products. And insurance products, what's nice about insurance products these days is there are a lot of different options. There are a lot of different options. So what that allows, it allows us, if we do this type of planning for individuals, it allows us to cater a product to an individual rather than fit an individual into a product. And the first option is the one that many of you are probably familiar with, what I refer to as traditional long-term care insurance. I pay my premium, I get sick, it pays for my care. If I never get sick and I pass away, it's always just an expense. It's never an asset. But also, these contracts, they can increase in costs. The companies can increase costs, and many of them have. Mass Mutual, for example, a couple of years ago, they increased their costs 77% on average for, I think it was about 80 to 85% of their policy holders. So if I'm looking at a client that's, we We want to be able to be comfortable everyone's on a budget. This option, of course, all of these are going to put people in a better position than nothing, but this could always be an expense and never an asset, and it could always be an unpredictable expense at that. So the second option is life insurance with a long-term care rider. Now, how this works, I buy a pool of money. For example, let's say $250,000. If I get sick and I need long-term care services, I can access $10,000 per month for 25 months. If I never get sick and I pass away, my beneficiaries receive $250,000, whether it be my loved ones, a charity that I'm involved.
Thank you guys for being patient with us. Sorry about that, Corey.
No, that's all right. And I'll back up just a little bit because I'm not sure exactly where we were lost. But talking about the life insurance with the long-term care rider, buying a pool of money, again, whatever you need for long-term care, you're able to use that. Anything that's unused, the balance goes to a beneficiary of your choosing. The premiums, you can structure them however you want. If you want to structure them where you pay 10 years, you can do that. If you want to pay 1 year, you can do that. And also they're guaranteed. These are predictable expenses, so you don't need to worry about increases in the future. The third option is one, it's asset-based long-term care. How it works is you buy, I'll give an example because I think it's easier to explain. Let's say I deposit $100,000 into one of these contracts. I have a $150,000 death benefit. If I pass away, my beneficiaries get $150,000. Not a tremendous amount of leverage, but I did not do myself or my family a disservice. Essentially, I bought a CD. Now, where the leverage is, if I need care, I have $450,000 to tap into. So the leverage is not on the death benefit. The leverage is to be, the leverage is on the long-term care. And if I want my money back, most of these contracts will give you 80% of your money back. In the last, or who I think this makes the most sense for is clients, maybe a kind of a CD coming due is almost a perfect storm with these because they need to be funded up front or over a 10-year period. So a CD coming due, money sitting in the money market account, things like that. Those are going to be the best bet for that. And the last option, I'm not as familiar with these because I don't use them as much, but again, it's important that they're there, is buying a long-term care annuity. Let's say we buy one, you get $100,000, for example. Your leverage, you'll get 2 or 3 times that, the contribution to tap into for care. I think it's nice that it's available because I'm able to exchange an annuity into it. I'm not losing control of the asset because I can still tap into the annuity for income. And also, it's nice for clients that may have some health issues because they're a little bit easier to qualify for because there's not as much promised leverage from the insurance company.
Really great information, Corey. Thank you. Which of these 4 options do you see people gravitate toward?
I'm finding most people gravitate actually towards the second one for 2 reasons. Number one, they may have legacy desires. They want to transfer assets to their kids, maybe a nest egg for their kids and grandkids. And this is going to provide the biggest death benefit. Number 2, you're able to stretch the premiums out a longer period of time. And what's nice with that is, let's say money's coming from an investment account. We're taking a smaller amount out annually, which is going to cause less of an income tax burden every year.
So we had really great information here from Corey. I really thank him for his time. Just wanted to summarize the presentation, what we covered. One is the statistics of long-term care, the concerns for caregivers and family members, and I think most importantly, the different options that we have for long-term care. We do recommend that there's a call to action. We recommend that you understand your options and build a care plan before an event occurs. Carefully consider the impacts of your decision beyond the finances to include your family, level of care, and quality of life. Be proactive in addressing financial risks and consider sharing this with your family. Please feel free to reach out to me and Corey. Together we can engage a proven goals-based planning process that may help you clearly see your full financial picture and ensure that you have a plan in place that prepares you for this type of planning. If you remember our previous presentation we had over in the fall, we did our wealth plan, and that is a process that we can talk about as well. We thank you for your time, and we'd like to open this up to questions.
Thank you so much, guys. It was a great presentation today. We've already gotten some great feedback in the chat. We will now start to answer questions that have come in throughout the presentation. If you haven't submitted a question yet, feel free to do so now in the Q&A tool. So let's see what we've gotten so far.
Great, thanks, Dave. Corey, I do have a question. Can you tell us a little bit more about how coverage is determined? What factors go?
Well, in Allison, we're talking specifically about an insurance product or qualifying for that. Now, these contracts, they do require underwriting and things that the companies will look at. They'll look at cardiac health. They're going to look at cancer. They're going to look at things like diabetes. They're also going to factor in morbidity issues. If I'm using assisted devices like a cane, a walker, or things like that, unfortunately, the insurance companies are not going to be able to make offers on that, and insurance might not be available. But in some cases, what we'll do is, let's say I'm in overall good health, but I've got a condition like osteoporosis, or I had a client a couple of years ago that had a continence issue. She was in good health otherwise, but she had a continence issue. So what we did was we bought a regular life insurance contract, and she paid for the care just out of her assets. And when she passes away, the life insurance contract is going to reimburse her estate for any lost expenses. So if there are health issues, sometimes you can find creative solutions, but they're going to look at underwriting. They're going to look at overall health. And if you want to explore this, I certainly would recommend you reach out to someone and they can look into something further for you.
Great. Another question here, Corey. If I have a long-term care insurance policy, how do I terminate that so I can change what I'm doing?
Well, and I get that question a lot. As far as a long-term care insurance policy, how do you terminate it? Well, if you just stop paying your premiums, your coverage is going to go away. In some cases, if you're in the middle of the year, you decide that you don't want it anymore. Some companies will reimburse you unused premiums, so you may get a small refund. Now, that's not on every contract, so I would check with your insurance company. One thing that I would mention again, I don't use traditional long-term care policies all that often, but if I see one that has something called lifetime benefits on it, I think that's a good contract to have, because lifetime benefits really aren't available anymore. And so I think that's important. So if I see a client with those and they want to terminate their contract, I certainly make sure that they have some things to think about.
Another question here, Corey. For all of these policies, what are the restrictions on what is covered? For example, can I choose any type of caregiver, or must I only be using caregivers approved by a plan administrator?
And that's a great question. And that's one that I get all the time as well. And there are generally two different types of long-term care. There is reimbursement long-term care. And what that means is this needs to be performed by a qualified practitioner, a qualified professional. And I need to be under a plan of care under a physician to tap into the benefits. So I can't pick just a family member to take care of me. There is another type of policy called an indemnity contract. And once I qualify, they send me a check, or the insurance company sends me a check for my maximum benefit, and I can spend it however I want. So it depends on the specific contract. So if I'm someone that I want my family to be able to come take care of me and I want to compensate them for doing that, if I want to pay the kid down the street to come over and clean out my gutters for me, I might look at an indemnity contract because it provides some extra flexibility on what I can receive the benefit for and what I can spend it on.
At what asset level does it make more sense to be self-insured for long-term care costs rather than purchasing insurance or annuity to fund long-term care?
I guess a rough number, it depends on spending, depends on assets. I don't know that this is a hard number, but I'm more comfortable with a client somewhere in the $2 million range, $1.5 to $2 million range. But I do this type of planning on clients all the way up to 10 plus million. And they look at it from an aspect of, I'm transferring risk to the insurance company. I'm not taking on this entire risk myself. And if I have assets that I can reposition into an insurance product, or I have assets that I know are going to go to my kids anyway, why not reallocate those into a life insurance vehicle and add a long-term care rider? If I get sick, I can tap into it for my care. If I don't get sick, that's money that's going to my kids. And if I look at, if I were to invest that money elsewhere, and you look at what the rate of return would be on the death benefit at life expectancy, usually it's around 5%, 6%, maybe even 7% tax-free. So it's really an efficient use of my money. So yeah, if I'm worth $3 million, I could probably self-insure. But if I have money to reallocate anyway, why not transfer some of the risk, or it turns into a really effective means of transferring my assets to my kids or a charity.
Another question here, Corey. Can you explain a little bit, how are the contributions in an asset-based plan, how are they paid?
The contributions being paid, I'll assume you mean the premiums being paid. And a lot of times it's, you can use cash, money that's sitting around. You can't transfer an annuity tax-free into a life insurance contract. You can transfer it into an annuity, but generally it's cash sitting there, or distributions from a retirement account. If I have, and I do this all the time, if I see a whole life contract with significant cash value in it, we can use that to help lower costs. And that's another thing to mention. If you're contemplating this type of planning and you have life insurance with a cash value in it, you can use that as an asset to help you pay for an insurance product.
And maybe to clarify a little bit more, what are the premiums paying for?
What are the premiums paying for? Well, generally what these premiums are paying for is it's paying for the death benefit. It's in those types of contracts, it's paying for the death benefit, but also the ability to access that death benefit earlier.
Does each individual have to have a plan, or is there an option for a couple's long-term care policy?
There are. If you look at traditional long-term care, some will allow spousal discounts and things like that. It's still a traditional long-term care policy. So it does have the limitations that we talked about. Again, everything's going to put someone in a better position than nothing. But One America has a great contract that is a joint contract. That's the only life insurance contract that allows it to be a joint. But when I see individuals looking into coverage and I'm using a life insurance contract to do it, I look at things of where does this, if care is not needed, where's the benefit needed? Do I need to replace pension or income to my surviving spouse? If I need to do that, a survivorship contract or a joint contract, it's not going to be advantageous anyway. If I'm just looking at covering my care, my wife's care, and anything I don't use is going to the kids or my church or whatever, for example, a joint contract will do that.
On a similar note, what are some of the best companies with comprehensive life insurance, long-term care riders?
I have a hard time saying one's better than another. And really, again, this type of planning is so individualized because everyone's so different. Everyone's goals are different. What's important to everyone's different. I use John Hancock quite a bit because their costs are a little bit lower. I like Nationwide because they have indemnity benefits rather than reimbursement benefits. Lincoln MoneyGuard has a great contract. That's an asset-based contract. So that's that one where it's less geared towards life insurance and more geared towards long-term care. You can put inflation protection on it. I have a hard time answering this as a general question without talking to the individual I'm doing the planning for.
Yeah, that makes sense.
Now, the life insurance with the long-term care, there's a question of, as far as typically sold without inflation. Thus, when it's needed, will it be ineffective? And I think this is a great question. I think this is a great question, and it's a question I get all the time. And now, if inflation protection is important, the second option, or the life insurance with a long-term care rider, without some tweaks, it's not going to be effective for you, and you're not going to be comfortable with it. There are really a couple of things you can do with it. As an example, is let's say $10,000 of my example earlier, that's not going to cut it in the future. You could buy a larger benefit. Of course, it's going to be a higher cost, but it might provide you with $20,000 per month instead of $10,000 per month. Again, the cost is going to be higher, but you're essentially baking in inflation protection for yourself. If you only need $12,000 per month, you're only accessing 12. You can access 20, but you're only taking 12. So that's one of the things that we do, is kind of bake it in by buying a larger benefit pool. Or if inflation protection is that important, that's what you want to see, look at like an asset-based contract, like a Care Matters, for example, or a MoneyGuard, like I mentioned. Another thing to think about is, a lot of clients, they tell me, well, in 20 years, the costs are going to be $236,000 a year if I need to go into a private nursing home care. Well, think about that. Insurance, that's not your only means to pay for your care in the future. You're still going to have your assets. And let's say we have a $10,000 per month benefit. It's not covering everything, but that's $120,000 a year that you're not spending. That's transferring $120,000 of the risk to someone else. So again, I know that's a long-winded way to answer the question, but either buy a bigger benefit pool or look at an asset-based product is what I would recommend.
Great. Thank you, guys. And thank you, everyone who submitted questions. If you think of any questions later, feel free to reach out to Kyle or Jonas, our other RBC representative, who is unfortunately not able to be here today, and they will get back to you as soon as possible. Thanks again to RBC for being on today. Thank you, Corey, for joining us. And thanks to everyone who joined in and participated. Have a great day.
This has been a presentation of the Patina Nation. To watch more content like this or for more information, please visit us online at www.patinanation.com.